welcome back to my channel. Welcome back to the Riggy Report. My name is Riggy and today we are going to discuss bank failures. Yes, bank failures. And while they don't really happen much nowadays, it's one of the biggest fears of savers and people with money deposited in banks as a recession starts to hit. As you all may know, the US economy entered into a recession earlier this year, and a lot of people are just curious and a little bit scared of what happens to their money should their bank fail. After all, after the Great Recession of 2008, a lot of big banks that were considered too big to fail, failed. And not surprisingly, a lot of people are afraid that these situations might happen again in 2022 or 2023, especially because of the big Credit Suisse scare that we all had a couple of weeks ago. But let's back up a little bit. What would even cause a bank to fail in the first place? Banks fail when they're no longer able to meet obligations. They might lose too much on investments and be unable to provide money when depositors demand it. Let's say you go to a bank today and they tell you that the bank has run out of money. Pretty much, the bank has run out of money. Our banking system here in the US is the fractional reserve banking, which I've already made a video about. That means when you walk into a bank and you deposit money, the bank keeps a fraction of that money in its reserves and they take the rest out and they invest it. Usually it's in the form of loans. So think credit cards, auto loans, home loans, business loans, things like that. When they make those loans, they make money through the interest that they charge on those loans. And from those interests that they charge on the loans, they pay you like a little bit of it just to keep you happy as their depositor and to keep your business coming. So they can take your money and loan it out and make even more money for themselves. Now imagine if some of the customers that the bank loans money out to start to default on their loans. If it's just a small amount of people defaulting, it's not really that big of a deal. The bank usually are able to sustain a big amount of losses because it offsets it with the shareholder equity. Now the shareholders of the bank might lose a lot of money, but generally the depositors are safer. And usually a lot of the big commercial banks already set money aside for loans that they might not be able to recover. So they already have a plan for it. However, let's say that the general economy has changed and there's a shift in the economy and now more and more loan holders are not able to make payments. The bank now has to decide what it's going to do with all these loans. Let's say 30, 40, 50, or 60% of the people that are of the bank's loans now become underperforming loans, meaning that they might not be able to recoup not only the interest but the principal of the loans that they lent out. Now the bank starts to get in trouble. What the bank might do is write down or write off some of the loans because they might not be recoupable. However, the bank still has obligations to the people who have deposited their money. People are still going to be needing to make rent payments, to make car payments, to make student loan payments, to just buy groceries, buy gas, and still live their lives, even though the bank has lent out money to people that can't afford to pay it back. Now, what happens? The bank may have some bonds or shares or assets that it can sell really quickly to raise capital to be able to meet its requirements, right? To be able to pay out people that need their money. Or a lot of banks here in the US, they have reserves at the Federal Reserve, so they be able to take that money out as a last resort to be able to stay liquid, right? However, once those liquid assets have been depleted, the bank is literally not going to be able to make any payments on behalf of its customers because it doesn't have any money. When that happens, if things get really dire, the bank is going to try to raise capital in any way that it can. And one way that it's going to try to do that is to borrow money from other healthier banks on the market. However, those healthy banks are not just going to lend money out to the struggling bank all willy-nilly. They're going to demand a premium for taking a risk of lending money to a bank that's not really healthy, and they don't really know if they're going to be able to recoup their money back. So they're going to charge the bank a higher interest than they're charging other banks on the market. And if that doesn't work, if no other bank is willing to lend money to that struggling bank, then it's going to have to do a fire sale. And basically what that is just selling off its assets as fast as possible, usually cheaper than what they would have gotten for it at market value, just to try to get emergency capital into the bank to avoid disaster. And if all else fails, if none of it works, that's when the regulators come in. Here in the United States, we have the Office of the Comptroller of Currency. They're the ones that manage and charter banks, and they have the ultimate power to just control banks and to monitor them. We also have the FDIC. They will come in and they will take over the bank. Usually they will try the hardest that they can to either save the bank by firing the people at the very top that were making the stupid decisions, or if that doesn't work, they will try to find another healthier bank to try to absorb the bank and try to buy it out so it will still be a functioning bank. If all else fails, because honestly sometimes some banks are just too far gone, they're not even worth saving, then what they're going to do is they're going to take everything, they're going to liquidate the bank and try to pay out the depositors. It is very difficult to know which banks are going to fail, because the FDIC does not make public when it's going to take over a bank ahead of time. They just storm in the office one day on a Friday, and the next thing you know, Monday morning, your bank is now being owned by a completely different bank. It's really scary, but there's a reason for that. They don't want to spook the markets. They try to be as efficient as possible and try to get things done as fast as possible, but sometimes, you know, things may just be out of control. Here in the US, we're very lucky to have deposit insurance in the form of the FDIC, but, and that is a big but, there are a lot of limitations. There are limitations, and that limit happens to be about $200,000 per bank, per person, per ownership type. So for example, let's say you had $255,000 in a bank, and unfortunately for you, the bank happens to go and the bank shuts down, and luckily you have FDIC insurance. The first $250,000 you're probably going to get within a couple of days. However, the other $5,000 you're not going to get at all. What's going to happen is you're going to receive a claim against the estate of the closed bank for the amount that's not insured. So for that $5,000. You would receive a receiver's certificate as proof of your claim, and you would get your money back whenever the bank's assets are finally liquidated. Now, this is a very long process, and it's very unlikely that you're going to get the full amount of your money back, to be completely honest with you, because a lot of the things that are liquidated are probably going to be sold at below market value, and a lot of the bank's assets are probably worthless. Otherwise, it wouldn't be going under, it wouldn't be insolvent, right? And honestly, bank liquidations take quite a while. If you guys remember, the biggest bank that went down in 2008 financial crisis was Lehman Brothers. And the Lehman Brothers liquidation just finished this year, September 2022, a full 14 years after the bank collapsed. That's when people have finally, like the last person, finally got their money back, finally got closure. So these things take a very long time. It's a very stressful, it's a very long and grueling battle to get anything over the $250,000 from the FDIC, unfortunately. Now, while this all seems really, really scary, we just have to take a deep breath and keep these tips in mind. First and foremost, you only want to deposit money with banks that are insured, with institutions that are insured. Usually, if you're going to a bank, you're going to see the big, bold FDIC signs all over their desk, all over their windows everywhere. You want to make sure whenever you put money into an institution here in the US that it is FDIC insured, because at least you know in the back of your mind you have $250,000 for sure insured, that should something happen to the bank that you would be able to get your money back. 2, don't exceed the deposit limit, because don't exceed the insured deposit limit. While it might be tempting to keep a large balance at one institution, because some banks offer private client banking, they offer premier banking, they give you special perks for having more money with them, it does pose a risk to you and your money. Should something happen to the bank, you're not going to get the full value, the full book value of your account back. So it's best to do number 3 and spread your money out and have different accounts at different financial institutions, because it keeps you safer, it gives you peace of mind, and you also get to have relationships with several different banks. So it gives you the ability to shop around a little bit and get the best care and get the best, advice and management of your assets. That is all I have for you guys today. If you have any questions, leave them down below, but don't forget to like, comment, and subscribe, and I will see you guys on